Good morning or afternoon. I don't know exactly what time is there while you are watching this video. First of all, I would like to say that I'm honored to be part of the 2023 International Congress of Actuaries. I would also like to thank you all for the interest in the subject and for watching this presentation. Um, I would like to thank Professor João for the co-authorship of this work and also for being my supervisor. We are going to talk about systemic risk here. To be more specifically, we are assessing the systemic risk in the Brazilian reinsurance market using complex network. First, I would like to give you an overview of the Brazilian insurance and reinsurance market. And after that, I'll explain why we decided to use this complex network approach. Okay. So why it is important to study the Brazilian market? First, because it is the biggest in Latin America. Second, it's a highly complex market. So we have one company that concentrates 30% of the reinsurance operations. And this company some years ago was a monopoly owned by the government. And which means that from 2007 to 2020, the number of reinsurers operating in Brazil went from one reinsurer in 2007, IRB, to almost 140 reinsurers. So the complexity of the market changed a lot. It's also important to study systemic risk because it has never been studied here in Brazil for this specific market. So we are also trying to fulfill this gap in the literature. Okay, so why complex networks? First, it allows us to directly model the financial network of the reinsurance market. This is because a network is basically a set of nodes and edges. So basically the nodes are the companies and the edges are the connection. So we needed to find which connection to use. So we used the coinsurance, reinsurance, and retrocession operations. So all our contagious risk measures are based on these operations. This is a pro. So a con is that we don't have specifically the relationship between counterparts. So we have to estimate this relationship, and I will show you how to do that in the following slides. Another pro is that this approach is also suitable to markets where the daily market value of the company is not available. So this is the case of Brazil. Like we have almost 280 companies, insurance and reinsurers operating here, but only 6 are publicly listed. So it's important to have a methodology that doesn't rely on the market value of the companies. A con of this methodology, a limitation, is that the contagious risk that we are measured are based on the exposure of that one company has with other due to operations of reinsurance, retrocession, and coinsurance. So it's basically due to the credit risk involved in these operations. Okay, so to be more technical, mathematically, what we have, what a complex network is basically a graph where you have nodes and edges, and these edges can have weight, and they also can be directed. In real life, in our specific situation, the networks basically the relationship between insurers and reinsurers. Okay, so imagine that you have a local insurer ceding premiums to a local reinsurer. So you have a connection due to the the retrocession operation. So it's the same object but with a different application. So you can have several applications of complex networks. Another way to represent these networks is by means of its adjacency matrix. So as we can see, we have this matrix where the cells represent the size of the operation. So you have a block of coinsurance, reinsurance, retrocession operations. You also have a block of zeros. This block of zeros is because you don't have operations from a reinsurer to an insurer. And as we can see in the diagonal, we also have zeros because we don't have self loops in this network, so I can't cede a premium to myself. It's worth mentioning that what we have in real life is the marginal distribution of this matrix, and then we have to find a way to estimate the cells based on the marginal distribution. So that's what we are going to do right now. So basically we have two main methods, the maximal entropy method and the minimum density method. The basic difference between these methods is the objective function that we want to minimize, while the first one wants to find the matrix that are more similar to a random matrix. The second one, I mean not random, but like the distributions are independent. So it's basically the multiplication of a column with a line of the matrix. So you want to find this matrix, but respecting the restriction that you don't have self loops. So it's an easy problem to solve in terms of computation time. While the second one is a combinatorial problem. So you want to minimize the sum of this indicator function. So in this method, we are going to obtain a sparse matrix in the minimum density, while the maximal entropy gives us a dense matrix. Okay, so by applying these methods, we have the network. As I mentioned, the first one, the MD method, results in a sparse matrix, a sparse network, while the second one results in a dense one. But what is common between these methods is that IRB is very important, and IRB, as I got involved in some fraud scandals, so it's a very important company that's also fragile. So we have to keep an eye on IRB. As we can see, the results haven't changed since 2018, so which means that our market's kind of stable. And okay, so we have this network, but what kind of information can we extract from this structure? So the first one is the degree centrality. It basically measures how popular a node is. So for example, we saw that IRB is very popular. The second one is the betweenness centrality. It works like, it measures how important the node is to connect two parts of the network or two communities of the network. We can think of this centrality measure as, for example, a city crossed by a river that has a bridge in the middle. So this bridge is very important because you have to use the bridge to cross the city. So it has a very high betweenness centrality. We also have hubs and authorities. So hubs, we can think of this centrality as a review article. For example, a review article will point to a lot of important articles. Okay, but this article is not pointed by other articles. So in this situation, you have the node will have a high hub centrality, while the authority is the node that is receiving the citations. Okay, so in our reality here, talking about reinsurance, we can think an authority as an international reinsurer that will accept a lot of premiums but will keep the risk. Okay, so these are the results in terms of degree centrality. So IRB is very important, and this is consistent throughout the time. We also have some insurers and local reinsurers that appears in this list, but the most important one is IRB. In terms of betweenness, IRB is also very important, as we saw, and this is an expected result because IRB, we know that IRB accepts a lot of premiums, and these premiums are ceded to the international market. So that's an expected result. So in terms of authority, what we see is that the international reinsurers are in general authorities, as in the example that I gave. So in terms of hub centrality, we have a lot of local reinsurers. This is because they are pointing to the very important insurers, the international reinsurers. And another interesting question. So far we saw like the role played by each insurer and reinsurer in the network. But one interesting question is, what if the system fails, and what does it mean? So we have some scenarios. So a scenario where IRB fails, and another scenario where other important companies fail. So this is basically a way to spread this information through the network. And we have an algorithm developed by Eisenberg in 2001 that help us like to estimate this contagious default, like the spread of the information around through the network. This was also used by Upper in 2011 and by Kano in 2016. By the way, Kano also assessed the systemic risk of the international reinsurance market. Okay, so we have this scenario, so IRB only failing, and we have another very important scenario where the top 5 in terms of weighted degree fails. So let's see what are the results based on these scenarios. It's important to say that the IRB only failure is the most likely, not likely, but more realistic scenario. So what we can see here is that when IRB fails, we have an impact of 2 insurers being in default by contagious, and 4 if we use the MD method. So the difference between the rows is that the top row is the ME method and the bottom row is the MD method. So in one we have 2 and the other one we have 4. So it's worth mentioning that the MD method can be used as an upper bound for systemic risk, while the ME method can be used as a lower bound. So in general, for the most realistic scenarios, we don't see huge impacts. Like we are talking about 4 companies out of almost 218. Okay, so final remark. So we found that IRB is the main systemic threat in our network, even though the impact is not huge, but it is an important impact because in other works, the impact was even less severe than this one. These results are very important because IRB got involved in fraud scandals. So this is important. This is a company that we have to keep an eye on. Our contributions, basically the usage of publicly available data. So this data is available on the regulator, the local regulator website. We evaluate the network topology, so we know exactly what is the role played by each agent. The creation of a stress testing framework, so this framework can be used in other countries where they don't have publicly listed companies. And we also obtained a way to estimate default probability caused by contagions based on the MD algorithm. The limitation is that we don't have the real network, so we had to estimate based on 2 methods. So we basically have a lower and upper bound, but we don't know exactly what is the systemic risk. So that's it. I hope I used just the 20 minutes that I had. I hope you enjoyed, and thank you.
Well, thank you, Acacio. Interesting presentation on systemic risk. And I would like to encourage all those who have tuned in to please submit your questions via the app. While you're doing that, I might lead out with a question. Can you provide us a little bit of context in the Brazilian environment? What are the types of underlying issues that might lead to an insolvency in the first place of any of these characters? You know, to what extent is it natural peril catastrophes or economic environment driven or class specific issues, or just a little bit of flavor around, you know, the sort of the context of the companies that you're looking at?
Yeah, well, I think the main problem here it's the management of these companies, because like we usually don't have natural catastrophes here in Brazil. So what we try to show in this article is that we have a very important company, which was for IRB, that is the company that we highlight in this article, was a state-owned company for a long time. And here in Brazil, the reinsurance operations were a monopoly of this company. So if you wanted to cede premiums in a reinsurance operation, you had to cede to IRB. And as I mentioned before, like this company in terms of management is very fragile because it was involved in 2018 in some fraud scandals and a balance sheet fraud scandal. And that's basically the threat that we identified in our market. So we don't have other big problems in the insurance and reinsurance market here in Brazil. But this specific company is an issue, and that's the motivation of this study.
Yeah, okay. I mean, that's quite an unusual sort of an environment, you know, for what the main trigger is. Well, although it doesn't sound totally unique, you know. I know that there are interesting systemic issues in other countries where some reinsurance gets funneled through a central body, and yeah, I'm open to comments from others on that if they know more. I'm not seeing questions at the moment. So do let me know if you're seeing any questions.
I don't have the app. I just can see the Zoom chat. So I don't know if there is a question. So.
Yeah. Have you yourself, Acacio, you know, looked at how Brazil compares with other international markets to see potentially, you know, the relevance of this for other countries and other places?
Yeah, I think the main difference here, I mean, we have two peculiarities here in Brazil. The one is that we don't have a lot of insurance companies that are publicly listed. We have 6 out of 230, something like that. And bank assurance here in Brazil is also very important. So we have a lot of banks here that own insurance company. So João and I also wrote an article about that. Brazil is the country where bank assurance has the highest percentage of the market. So bank assurance started in France, but it became more popular here in Brazil. So I would say that those are the peculiarities of the Brazilian insurance market, that it's definitely different from other countries.
Yeah, right. That's interesting. I mean, it sort of begs the question as to whether there would be a systemic risk or contagion issue with banks as well.
That's a very interesting question. It's hard to answer because we don't have data about that. Like, because as I mentioned, like the insurance companies here are not publicly listed, so we don't have a lot of information about them. But an interesting question to answer is this inter-industry contagious. So what a bank failure can cause in the insurance market, because they are at least here in Brazil, we have this very strong connection between these two markets.
May I ask a question?
For sure. Go for it, Mary.
So do you think that if IRB failed, the Brazilian government would bail them out? Or do you think they would just let them go down?
Well, the point is, the Brazilian government has part of the IRB shares and also the biggest banks here in Brazil. So it's basically owned by these big banks and by the government and some minor investors.
Yeah.
So I would say that the government would bail out IRB because it's very big. It would be like a disaster if this company failed.
So it'd probably be the right thing to do, in fact.
Exactly, probably. Because here we are measuring in this study, we are measuring like the risk due to the credit exposure that the companies have with each other, but we are not able to measure what kind of effect it can cause to the real economy, like people seeing that this huge company failed. So
yeah,
so